Hey guys, I want to go over three businesses today that I think could be great investments and that will beat the market in over the next few years. And the first one is a very hated stock that no one likes. It's PayPal. Yes, PayPal. So the reason I like PayPal is because of the fact that it's trading at a very low multiple with very strong fundamentals. Let me go over this. So first off, in PayPal's first Q1 release of this year, they have $9.6 billion of cash and cash equivalents and $4.6 billion of short-term investments. So we're talking about $14 billion of straight cash with only $9.5 billion of long-term liabilities. So we're talking $14 billion of cash, which is 1/4 of their market cap. So 1/4 of their market cap is straight cash. You know, $15 of their share price is basically straight up cash, which is super impressive. Also, you know, apart from their really low multiple and strong cash balance and balance sheet, they are still growing. You know, before we had double-digit growth, but we're not growing so fast anymore after COVID. And we're still poised, you know, to grow 7 to 8% this year. First quarter, we had that 9-10% growth. And I think we're going to beat the 7.66 that's predicted by analysts. But, you know, we're still going to grow 7-8% on the top line this year, which is very impressive for a company that is generating over $5 billion of free cash flow and trading at a forward earnings of 14. Okay, another thing is that earnings per share, which, you know, I'm showing you right now, it's going to be 373. This was actually revised upwards. You know, it's gonna grow this year. And it's going to grow at high single digits. That's what management said, but they have a history of sandbagging. This new CEO, he always sandbags guidance, so we're likely going to beat that. Okay. Another thing I want to bring up is the net income margin is decreasing, yes, but the reason the net income margin is decreasing is because of the fact that if you look over here, PayPal's unbranded checkout, the Braintree, is growing so fast. It's 26% compared to the branded checkout, which is 7%. And Braintree has lower margins. So, and if you look at Venmo, is also growing as well. So management has said they're going to start charging more for these unbranded services and also Venmo. So I think, you know, the fact that we're getting over for $5 billion of free cash flow, and, you know, a little bit of that is stock-based compensation, like 1.5. But this year, if we get like 5.5 billion of free cash flow and 1.5 billion of stock-based compensation, that's like 4 billion of free cash flow, which is, you know, price to free cash flow, excluding stock-based compensation of like 14-15, which is very, very impressive. So I think this is a great business, you know, for the price. Okay, so another business that I love right now at this current price is Lululemon. Lululemon is at like 3-year lows, and I think a lot of it is unjustified because of the slowdown in revenue growth. And some of their latest products, a lot of people didn't really like them. So, just to talk about their balance sheet real quick, you see 1.9, 1.3, they have a little over $3 billion of straight cash. Short-term liabilities, long-term liabilities, you can see right here, nothing to worry about at all, considering they are producing a decent amount of free cash flow. I think over $1 billion this year. Very, very solid. Not too many notes coming up, I think, as well. So very good balance sheet. Talking a little bit about the Q1 report, revenue growth increased 10%. Now, a lot of the drop in price was because of the fact that, you know, North America growth is very tiny now. It's only 3 or 4%. But that other 7% blended rate is coming from the fact that China, Asia, and some other countries are taking their products are, you know, growing 30% per year. So the blended take rate is around 30%, and I think the market didn't like this as well. Comparable sales, though, up 6-7%. That's what you want to see in a retail business. International comparable sales, amazing, 25%. And, you know, we can see because interest rates are up, obviously, you know, at least in North America, Lululemon's kind of expensive, right? So people aren't going to be buying it as much. But gross profits also up 11%, gross margin up 20 basis points. Very, very good. And also you're getting, you know, the $1 billion stock repurchasing program, and their stock-based compensation isn't very high either. So, you know, 1 billion from the market cap, we're talking like a 2% shareholder yield. So the fact that, you know, we're growing 10, 11%, maybe it's gonna be higher if rates get cut. And then you're getting that 2% shareholders yield. So that's like a 12% yield right there. And I think a bigger portion of that yield could come from the fact that could be a small multiple expansion. See right here, it's showing around 17.5 times earnings. I don't expect us to go back to the mean unless we grow faster. Mean in the last like 5 years is 41. Even if you take the last 3 years, it is 34. I don't expect us to go back to 30 times earnings because, you know, revenues were growing really fast before. If you look at percentage, we were growing higher double digits. Here 42%, 24%, and now we're still growing double digits, but we're gonna grow a little slower, you know, 11%, 10%. This quarter was 10%. So, you know, maybe we don't get back to 34 times earnings or 30 times earnings, but I mean, at like an 18 times earnings now, I think we can get back to mid-20s, and that would take your 12% return even higher, maybe 15, 16%. So I think, you know, given this price right now, and also if you look at net income margins, they're supposed to go a little bit higher or stay the same. And if you just look at EPS in 2025, 2026, it's supposed to go up double digits. So, I mean, you'd think the business is suffering heavily based off the stock price, but I mean, we're still growing double digits, 2% shareholders yield with the buyback program. Really good stuff. The fundamentals with Lululemon are really good. We're going to get over $1 billion of $1.5 billion of free cash flow this year. Very, very good stuff. I think Lulu is a very great business at this price. The third stock that I want to talk about is Ulta Beauty, and Ulta Beauty hasn't really moved much in the last 5 years at this specific price, but it did have a run up just a few months ago. And I've actually traded this stock twice. You know, I always buy it at the high 300s and then I sold it when it got a little like in the high 400s. But now I've started a position again under $400. I've been averaging down as it goes down. And I just want to share with you, this business is super sticky and I love this business. So we can see net sales is low single-digit growth, nothing crazy. And you know, you got to remember, Ulta Beauty, it is a little bit more expensive, but makeup business is super sticky. People always need makeup, perfume, all that stuff. Super sticky business. Okay, but gross profit, it's staying similar. The net sales has gone up slightly. And you know, I think the market wanted to see bigger growth. They wanted mid to high single-digit growth, and this is part of the reason why the stock has gone down so much, because of this drop in revenue growth. But we can see net sales still increased low single digits, 3.5%. Comparable sales gone up a little bit in a time where comparable sales usually goes down for these type of businesses. So I mean, that's very positive. You know, just like I said, when the rates come down, this will go up even further, but they're still doing very good considering what's going on. Cash and cash equivalents 524 million with the cash, and they also don't have really much debt at all, so I'm very happy with that. And you can see over here they still have $1.8 billion left of their $2 billion. So they didn't buy back shares when the stock was really high in the 500s. They still have 1.8 billion right now, and I think the stock is undervalued, so that's really good because they can, in my opinion, buy lots of shares with that 1.8 billion. So that's very good, considering the fact that they don't have a lot of debt. That's very impressive. They've also opened like 40 to 50 new stores this quarter, so you know, as they increase stores, increase their gross margin, it's going to be very good. But you know, there's capex costs associated with that. So there's 400 to 500 million dollars of capex and their depreciation and amortization expense. But they're going to have a $25 to $26 earnings per share, which is like $1 less in earnings per share. So the market didn't like that either, but very strong otherwise. Like I mentioned before, that 524 million in cash, really consider this cash too, so it's more like 725 million in cash. And like I mentioned, nothing worrisome about the liabilities. They don't really have much debt at all, and not much goodwill either, which is nice. And they have a lot of inventory, so you know, as they go through that inventory, and you know, historically Ulta has been able to go through that inventory really well, so I'm not worried at all. And they're very profitable. So just want to show you, we're trading at 14 times earnings, historically very low. historically very low, but given that revenue growth has slowed, some of it is warranted, but I think it's too much to the downside. Very sticky business. But like I said, 2024, it's poised their total revenue growth. It's going to be mid to high single digits, 14 times earnings, and EPS is going to be, $25 to $26 a share, like the guidance mentioned. Analysts are saying 25.5 basically, but that's going to be essentially flat from 24. But going on from 25 to 26, 27, we're going to have double-digit growth again. And I think their analysts are predicting, people start spending more on like these essential goods. And yes, I consider makeup an essential thing. Women love it. My girlfriend loves this stuff. So I think it is essential, and it's going to go back to double-digit growth as rates go down. But right now, single-digit growth is okay for this valuation, I think. And with that $1.8 billion of share repurchasing and not much stock-based compensation, you're getting an extra, you're getting an extra return on top of the top line, mid to high single-digit revenue growth this year. The gross margin, it's doing very well, considering that sometimes they're having to put some discounts on things. It's still going to be 39%, very solid. And you can see here, they're still going to have a bunch of free cash flow. It's going to be like $1 billion of free cash flow. So very, very impressive. $1 billion of free cash flow. Earnings per share is going to reaccelerate from next year. And I love Ulta Beauty at this specific valuation at 14 times earnings. I think it's very cheap.